Good morning, Wall Street winners. It is Wednesday, March the 26th, and the malaise of the tariff pain is still upon us. So, as we wait for Liberation Day on April 2nd, when we hear more around the specifics and hopefully more around a surgical type of tariff implementation as opposed to a broad brush, we will hopefully be able to start to put the tariff nonsense behind us, at least understand how to work within the context of the new economic trading framework, which will help decisions to actually get made. But that's kind of where we are right now. There's a lot of just generic news that has very little to no impact on the markets, or should have little to no impact on the markets being announced today. So if we take a look at the markets, I think it's going to be a pretty ho-hum kind of day. We've got the Dow Jones up just about 0.1%, 0.12%, up 50 points. Whether that remains or not remains to be seen. The S&P 500 is basically even, and the Nasdaq is down 0.12%, down 25 points. So not a huge amount going on. The euphoria that we saw on Friday and Monday around potential shift from President Trump around blanket broad brush or broad stroke type tariffs down to more of a targeted surgical type of implementation. That market euphoria has definitely faded. And if we scroll across, interestingly enough, crude is getting close to $70 a barrel. So up at 60 cents, 59 cents right now. I think we have the potential for oil stocks to jump a little bit. VIX is up slightly, but in the 17s, mid 17s, so still fairly low based on the amount of uncertainty that we have right now in the market. You look at retail, I would be steering clear of this. We do have Lulu announcing results tomorrow. So that's one that if you're a big Lulu fan and if you believe that or know that sales are up and revenue is up and they're positive on the future, you could jump into that one. I would be very skeptical there. We even heard from the spice maker yesterday, McCormick, and their results were okay. Their profitability actually shrunk by, I believe, 2%. Their revenue was okay. And that was a bit of a surprise, being that if people are eating more at home, they typically consume spices in their cooking. But that doesn't seem to be the case. Hasn't had a huge impact on that company's revenues, and I'm not sure what's going to happen there going forward. Maybe that'll be something to revisit in a quarter if the economy does tend to turn more negative and head towards, say, stagflation or a recession, where it looks like we're headed into right now. I think the fear, in my opinion, right now is that Donald Trump in particular, but the US administration is taking a very cavalier approach to the economy. And the one thing that we've learned, one of the many things we've learned out of COVID, is you can't turn the economy on a dime. It's like a cruise ship or an oil tanker or one of those large shipping vessels with the container ships. It takes a while for those to turn around and head in the opposite direction. So when you have forward momentum, it's takes a while to slow down that forward momentum. And then for negative momentum or reverse momentum to pick up, that takes a while. And then getting it back to forward momentum is a difficult thing to do. And that's the economy in the context of these big ships. Um, and we've seen what these tariff announcements have done to the economy is it has slowed it down. It's caused the US consumer, which drives the US economy, to think twice about purchases and think about potentially saving, putting together a bit of an emergency fund in some cases, so that if they are caught in a scenario where they lose their job, they've got a few months of income or resources to live off of. And we're seeing those cutbacks having a huge effect on the spending cutbacks for the consumer, having a huge effect on the economy and on earnings. So it is a bit of a interesting time for us to be in, and I think what we're going to see is a further correction to these markets, and it could be another 10%. I don't know what the percentage is going to be, but I'm pretty confident it's going to be at least a 5% drop, and that's going to be across the board. I don't know if there's too many sectors that are going to be spared. I think one sector that could bounce back quickly, as it's one of the first to announce earnings in mid-April, which will be shortly after Liberation Day, is the financial sector. So I am somewhat bullish on the large investment banks because they have a way of making money in uncertain times. And I don't think they're going to be as prone to the smaller regional banks to defaults on loans and mortgages that we're likely going to be seeing as we head through this. And then another sector could be oil. We could see oil take a bit of a pop, although when manufacturing goes down and the economy shrinks, oil typically shrinks with it. So that is one of the things to consider. One of the I'll say predictors of an economic downturn or an economic jump and prosperity is typically housing and new housing starts and housing builds. When the economy is picking up steam, then we usually see an increase in new home sales and new home builds. And when the economy is shrinking, we usually see the opposite. We see a slowdown in housing sales and we see a slowdown in new builds. And I think if you look at Florida as one example, but many other states, we are seeing a huge amount of homes on the market for sale, but not a lot of sales. We also have a tremendous number. I think there's over 1 million empty homes in Florida, just as one example of one state. So that's a red flag as well. We get into technology, and yesterday was a bit of a mixed bag. It's a mix of red and green on the screen, but there's not a huge amount of movement. One that's moving huge right now is Team. Team's down $15 or more in the pre-market. I'm not sure what's leading to that. I haven't read into that, but they had some incredible results last quarter and a very, very positive future forecast. So that might be one to jump on and buy in a bit of a dip here, as that seems to be one of the anomalies as we scroll through into the pre-market. And then if we go down into finance, I think this is where I would probably be, I'm going to be spending most of my time in the next couple of weeks is in this financial sector. I think that if we can see some drops in Morgan Stanley and Goldman and JP Morgan as we head into earnings and they become a little bit more attractive from a valuation perspective, I think that is where we could see some upside and some positive future forecast and guidance. Some of these firms are saying that they believe M&A will be reduced, but we are hearing, we heard a lot in the last couple of days about new IPOs. We've heard about BlackRock buying, although BlackRock is already publicly traded, but it is making acquisitions in ports around the Panama Canal from CK Hutchings or Hutchinson, one or the other, the Chinese or Hong Kong-based firm owned by the K Shing Company. I'm not sure if I'm getting that name right, but one of the huge uh, Chinese billionaires out of Hong Kong. So there is opportunity. There always will be opportunity, but your best way to take advantage of that is to maintain your cash position. So be very risk averse here. One of the things I've started to do to minimize my risk exposure and keep a higher level of cash is I've started to do more or make more options purchases. So I've been buying puts and calls, more puts than calls, but I have been buying a few calls. And I've been making some investments using those financial instruments. And the benefit to doing that is that the percentage returns, now losses as well, but the percentage returns can be greater, and your cash exposure can be much, much less. So that's one way to play this very turbulent and volatile market and maintain higher cash levels in your portfolio so that you can jump back in when things start to turn around. And I don't think it's going to be an immediate turnaround because, again, going back to that analogy of the cruise ship, it's going to take some time for this to course correct. I don't think we're going to see that until probably through to the end of the second quarter. So be cautious and be be put a lot of thought into your trades before making any large investments right now, because preservation of capital will earn you more in the long run than a short-term quick purchase that you thought would turn around quickly that actually leads to a longer term loss and a lot of pain in your portfolio from a return and cash and capital preservation perspective. So good luck in your trades today, and if you're liking the videos, please hit the like and subscribe button.